So I think earnings are super important. Right now, I think they take this, breaking news flavor because, to your point, valuations are so high.
All right, joining me will be Matt Bartolini, Global Head of Research Strategist at State Street Investment Management, who, of course, is the country's third largest ETF issuer, now over $2 trillion in U.S. listed ETF assets. That's across nearly 180 products, including the recently launched State Street Spider Portfolio Nasdaq-100 ETF, ticker QNDX. This is now the lowest cost Nasdaq-100 ETF on the market in what is a quickly expanding category. And so Matt and I are going to discuss that ETF along with the lowest cost S&P 500 ETF, the State Street Spider Portfolio S&P 500 ETF, ticker SPYM, which was recently selected by the Treasury Department to serve as the default option for the new Trump accounts, which that's a nice little win for State Street on an ETF that already has over 50 billion in inflows just this year. It's continued to climb the ETF leaderboard. So we'll talk about that. And then Matt and I will also get into broader ETF flows, just in terms of what's standing out to him at the moment. So it should be a great conversation. Now, to start this week, I'll be joined by Cinthia Murphy, Director of Research at VettaFi. And we're going to take a look at an ETF category that's seeing a real uptick in investor interest this year, and that's alternative ETFs. So think multi-strategy alternative ETFs, managed futures ETFs, those sorts of products. And if you look at flows, these are definitely now getting some looks from investors. And so Cinthia and I will discuss some of the drivers behind that, and we'll also highlight a handful of alternative ETFs that are standing out right now. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with VettaFi Cinthia Murphy, who is joining me from New York. Cinthia, welcome back to the podcast.
Hey, Nate, always excited to be here.
All right, so you recently wrote about how alternative ETFs are punching above their weight this year, right? ETFs like the iShares Systematic Alternatives Active ETF, ticker IALT. You mentioned iMGP, DBI Managed Future Strategy ETF, ticker DBMF, and there were several others. But I was looking, so IALT has taken in over $5 billion this year, $5 billion. DBMF is nearing $2 billion in inflow. So there clearly has been an uptick in interest here. And in your piece, to sort of set the backdrop, you highlighted three factors standing out in the equity market right now, which is maybe helping drive some of this interest. And I want to go through these real quick and then obviously have you add some color here. So first, you said performance is broadening, that we're seeing areas like small caps and mid caps outperform. So that was one. The second thing you pointed to is the concentration risk in major indices, which of course that's been well documented. We've talked about that in the past, but obviously that is a concern for some investors right now. And then lastly, you noted how there's been a positive correlation between equities and bonds. And on that one, this doesn't have to do with correlation, but I thought you would appreciate it. If you look at something like the Vanguard Total Bond Market ETF, ticker BND, that's negative for the year, which might surprise some people. And so I threw a lot out. To start, I'd love to have you add some more color here, because again, you say all of this is contributing to alt ETFs getting some more looks right now.
I mean, we've talked about alternatives before. Is a tough category because it's populated with a lot of complexity. It's populated with a lot of one-of-a-kind strategies. But in general, as a call to action, they are known as diversifiers. So when you think about your 60-40 portfolio, and when you think about correlations between bonds and stocks getting kind of positive or close to positive, it has ebbed and flowed this year. It's alternatives provide a completely different return stream. And what's been interesting this year is that we look at the category as an asset class. It has taken in over $30 billion in assets, which we have almost $1.2 trillion in assets it flows this year. So 30 billion is a drop in the bucket, but that's about 2.5% of total flows for the year into the ETF landscape overall. When as a category, alts represent less than 1% of total market assets. So it's punching about at a 3x its footprint, which is notable. It's also notable relative to other asset classes like commodities, currencies, which are also diversifiers. And in the aggregate, commodities have taken in about $1 billion. Currencies are negative outflows this year, and Bitcoin is in that category. So alts are kind of coming into a role of the ultimate diversifiers this year, and we're just looking at that number to confirm it.
When you talk about portfolio diversifiers, I think a big component of that, and this is embedded in some of those drivers that you mentioned when you talk about performance broadening out in the market and some of the concentration risk. But I think a lot of people are looking at the Mag 7 companies and some of the other big behemoth companies, and they have some real questions around valuations right now. And this week we have some pretty important earnings coming out. I think I'm not real big on focusing on the short term and looking at quarterly earnings reports and trying to glean how to position longer term. But I do feel like earnings are maybe a little more important than they have been in the past, right? So we know earnings are always important over the long term. But I guess my question to you is there more risk over the short term in that some of these Mag 7 companies and some of the other, again, headline companies, they need to justify their valuations. And especially if they're in the AI space, which a lot of these are, they need to justify the CapEx spending around AI and those sorts of things. Are earnings more important than usual at the moment, I guess, if I had to boil this down?
Yeah, I think that's a really interesting question. I mean, earnings are what? They're a metric of fundamental strength, right? So if you're a long-term investor, earnings and revenues, profits, that fundamental picture of a company are key drivers in your decision making, like which businesses, which industries do you want to own long term. So I think earnings are super important. Right now, I think they take this breaking news flavor because, to your point, valuations are so high a little bit because we're so momentum driven right now. We're so heavy sentiment driven. We're all like super bullish on AI, but we need confirmation that our sentiment is on the right track, that we haven't gone off the rails. And so we've seen it, with every earnings season, it feels like it goes more from we reward a little bit the winners, then we punish dramatically anybody who disappoints even slightly because we are betting really, really heavily on some of the Mag 7 stocks, the AI big names. So we not only need confirmation, we need that forward guidance that it's going to tell us, yeah, you're on the right track, stay on this track, because we're all nervous about how stretched out this story's been.
In terms of those nerves in the market, and let me think how to frame this. So, and I'm actually going to discuss this with State Street's Matt Bartolini a bit later, but follow me here. If you look at the ETF leaderboard so far this year, it's still dominated by the top-heavy major index ETFs. So S&P 500 ETFs, Nasdaq-100 ETFs. There's a total U.S. stock market ETF in the top 5, and actually going back to bonds, BND is in the top 10 of inflows as well, despite that negative performance I mentioned. And if investors have real concerns around valuations from Mag 7 companies and this concentration risk, that doesn't seem to comport with these flows into the top heavy index ETFs. And so my question is, do you think that shows some complacency among investors, or do you think those types of ETFs are going to take in money no matter what the environment is, right? Neither rain nor snow nor gloom of night. And so we really shouldn't read too much into the flows into massive plain vanilla ETFs.
I think I'm actually kind of happy to see that, Nate. I think market participation is always a good thing, even when the going gets tough. As we know, market timing is your worst possible choice. So from that perspective, whether you're dollar cost averaging into your broad indices or whether your domestic bias is super strong or you're just bullish in U.S. equities, I think the market participation consistently is a positive. I will note though that if we look at the flows into say S&P 500 funds, they have really been focused on who? VOO and SPYM. They have also gone a lot to RSP, the Invesco Equal Weighted ETF. So what you have there is lowest possible cost on S&P 500 market cap or an equal weighting. Both those things tell me that this is smart in the sense that you're either diversifying your S&P 500 exposure a little bit with an equal weight, or you're continuing that exposure but paying as little as you can for that exposure. So I also think that's a silver lining, that if it's complacency, it's relatively looking smart to me. So I'm positive on it.
Do you think we will ever see an ETF leaderboard that doesn't have VOO and SPYM and those types of ETFs on it? Or will it take a 40% drawdown, 50% drawdown to change the composition there? Or will it never change?
Yeah, I mean, it's hard to imagine a day when that would happen, because those funds are, I mean, they're household names now. Everybody knows them, so it's hard to imagine any good investor diet that doesn't include these staples. But I would never say never. Who knows, right?
All right. So coming back to alternative ETFs, you mentioned 30 billion in inflows this year into those products. And in terms of specific ETFs, I mentioned the iShares Systematic Alternatives Active ETF, ticker IALT, and the iMGP DBI Managed Future Strategy ETF, ticker DBMF. Those two are clearly standing out. And I know with IALT, some people will say, well, that's just a BlackRock model portfolio allocation, right? And so they sort of dismiss the flows into that product. I actually look at it the opposite way because I see this as BlackRock telling you that they think alts are important right now, which seems like something you should pay attention to. Not that BlackRock is the market soothsayer, but I think that's important that they're deciding to make an allocation to an alt strategy in their models. Do you agree with that take? And I guess, is there anything else you would note with either iAlt or DBMF?
Yeah, no, I agree. I mean, this is the largest asset manager in the world and is taking its model. And I think IALT replaced some of their long dated bond positions at the time of that model rebalance. I mean, that's something. IALT is a fund BlackRock brought to market just last December. It's brand new. And it puts together BlackRock's best liquid alts expertise, and it brings multi-asset and multi-strategies together in one portfolio as this beautiful plug-and-play liquid alt solution. And now it's in their models. I mean, to me, it says a lot. It carries a lot of weight. It may not be what we would call organic flows, but it's directionally important. Here's BlackRock saying, hey, take a look at this. And what's interesting is if you look at the portfolio today, a lot of the portfolio is allocated to short dated bonds. I mean, nothing screams more, hey, time to protect your cash than parking your money in cash, even with the liquid alt. So if there is a call for diversify and protect, I think this is telling that story.
What about DBMF? Anything standing out to you on that? I mean, I know we go back to when, what was it, 2022, when both stocks and bonds were down together, and that performed extraordinarily well. Anything you would note regarding DBMF?
Yeah, I love DBMF because it's been fighting the good fight for a long time. So since I think it was 2019, and it has beautiful years when it attracts a ton of money, when investors really need a diversification, and then it loses assets when folks get all bullish about their equities or something else or Bitcoin. And it goes back to they're going back right now over a $1.5 billion, almost $2 billion so far this year in asset flows, which again, because of also that trajectory, I mean, this is a hedge fund replication strategy that's using managed futures. I mean, it's all about multi return streams and diversification. And we see that fund really stand out and hit the headlines every time. Diversification is really critically important. So every time I see that fund pop on top flows, I take notice because it tells me the market is feeling like this diversification is important right now. Here's the BMF again, ranking high. So I love that fund.
Yeah, I'll just add to that. And it's funny, I had this conversation with Andrew Beer maybe a month or two ago on here. Andrew, of course, is behind DBMF, but there's a huge behavioral component to DBMF and all of these alternative strategies. And that you were saying, you may see flows ebb and flow, no pun intended, depending upon the market environment. But he would argue, and I would agree, that this is something that you put in your portfolio. So think of it as like insurance. So when things do go sideways, maybe when stocks and bonds go down together, these perform. You don't want to see people jumping in after that happens, right? You don't buy insurance after the house is on fire. And so the point being that I think there's a lot of education that needs to happen around alts where you may go several years and it'll quote unquote underperform, say, the S&P 500 if you're comparing it to that. But that's not what these are designed for. They're designed to be portfolio diversifiers when, again, say correlations between stocks and bonds uh, rises and maybe there's negative returns there. I just think that's really important, the behavioral component to alt strategies.
Yeah, and I think that's one of the key challenges for the category is especially in the current market over the last few years, we kind of got addicted to outsized returns. Everything we see is massive numbers, triple digit gains, it's records here, records there. So I think we kind of lose sight of diversification means something maybe not going super on your portfolio, but that's by design. So all to have that huge conversation hurdle, if you will, for adoption. But they work when you're really looking to diversify from equities and bonds.
Well, and the other piece too is just education in the space as to how these products work. These are more complex than obviously other ETFs on the market. I think that's always been a headwind for the space overall, but I do think issuers are doing a better job of trying to educate the marketplace. I think of like Bob Elliott and Unlimited Funds. He's doing a really good job of trying to educate around alts. Andrew Bear, who I mentioned, they're really trying to help advisors and investors understand the underpinnings of these products. And I think that's really important. Obviously, you have to understand what you're investing in. But I do think that's been a headwind because, again, some people will look at these products and go, I don't understand them. And so I'm just not even going to bother getting involved with them. Besides IALT and DBMF, any other alt ETFs you would point to? I know we could go through a bunch of these, but just for the sake of time, are there another two or three that you find particularly interesting?
Yeah, it's a category like we said earlier. There's a lot of unique strategies, and from an asset class perspective, a lot of the buffer strategies fall into alts. A lot of the options based things fall sometimes into alts. I think Box has been hugely popular, BOXX, which is that box spread T bill like exposure ETF that, what it does is basically provide a T bill like exposure, but at a better tax treatment. It converts your gains from ordinary income to capital gains over time. So that has been hugely popular since it came to market from Alpha Architect and it's gotten a lot of assets. CTA, it's another managed future strategy from Simplify. The Simplify folks have a lot of expertise in the alt space. So I think their products always have a unique twist that makes them really compelling alternatives portfolios. So I like CTA, which is also trend following strategy. I like ALLW from State Street, which we have Matt coming up, so he can talk more about it. But that's also, a multi-asset global portfolio that is navigating for the current environment, is not forecasting what's coming next. It is your diversification for today based on what was working better today. And in that portfolio too, there's a lot of short-term debt right now in there, which again, I'm just thinking the alts themselves are telling us, protect your capital. I think it's a really interesting ETF as well, which is relatively new in the market as well. So a lot of really good funds in that category.
So it sounds like you would lump, say, buffer ETFs into the alt category, which I guess I would agree with that because you may have a different pattern of returns. But I do think correlation, they're going to move, generally speaking, with the markets. But it depends on where your floor is, right, and where the upside cap is.
Yeah, 100%. It's that's one of the challenges with alts. The way the data we get and the way FactSet quantifies them or qualifies them, that's the asset class breakdown, and these funds fall into there. So from a flows perspective, just to stay on the same lane, a lot of these funds are in there.
Yeah, because Box stands out to me in that you're essentially replicating, you know, Treasury T-bill returns, which doesn't feel alternative, but it's interesting. You're right. Depending upon who the data provider is and how they classify things, you may get some different products in the categories. What about gold and crypto ETFs? I think some people might lump those into the alt category, and there are other asset classes like that as well. But do you think we could see interest pick back up with these ETFs? And I know flows and performance around gold and crypto have not been good this year, to say the least, especially for crypto. But could areas like that benefit from the same factors we were discussing with traditional alt ETFs?
Yeah, as literally alternatives to stock and bonds, theoretically, yes. I mean, there's nothing really alternative about them. Gold is commodities, and Bitcoin falls into the currency bucket. But I so as a diversifier is 100%, Nate. You're spot on. I think the challenge has been that they're seen as more store of value, both gold and now Bitcoin. Bitcoin has moved from a high beta play to a store of value play back and forth since it went mainstream, from my perspective. But as store of values, I think then the performance expectation is different than your expectation on alts. From an alt ETF perspective, a liquid alts, you expect that sometimes they may not work because they're diversifying, they're uncorrelated. When you look at gold and Bitcoin, I think investors are expecting a store of value. So when it doesn't perform well, I think you're less likely to want to hold on to them. Your requirements are different from that asset. So maybe there's a perception barrier here. I don't know. That's my hypothesis. But theoretically, they're diversifiers. They would fall into the diversification bucket. I just think the folks look at them differently than they look at the liquid alt space.
Yeah, I just bring them up because I think that gold for sure and crypto more recently, if advisors are looking at, say, a 60-40 portfolio and they go, oh, I want to allocate to quote unquote alts, that's where they're looking is to gold or crypto. But you look this year, you know, IBIT is down, what, 25, 26% year to date. GLD's down about 6%. And so to your point, that's clearly a different pattern of returns from, say, an all W or DBMF or an IALT. And I think a lot of that just gets back into education in the alt space, right? It's like gold and crypto for some advisors, it's an easy button. Okay, I'm not going to do my homework and look at some of these other alt ETFs. I'm just going to allocate to gold or whatever. And I think that's part of the issue here as well. But I definitely think there's a large amount of advisors and investors who they're interested in all of these categories, and I think we could see a real uptick depending upon what happens with the market moving forward. But Cinthia, excellent stuff as always. Uh, Fantastic insight. Thank you for joining me this week.
Thanks, Nate. It's always a pleasure.
That was Cinthia Murphy, Director of Research at VettaFi.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Matt Bartolini, Global Head of Research Strategists at State Street Investment Management, who currently has over $2 trillion in ETF assets. That's across 179 products. And I'll tell you, they have had a very noteworthy past month or so with a couple of ETFs in particular, as I'll get into with Matt, who is now joining me. Matt, it is always a pleasure to have you on here. Thanks for taking the time.
Yeah, thanks for having me back on.
All right, so there have been a handful of very noteworthy State Street ETF stories recently, and we're going to get to those, but I always like hearing your broader industry takes as well. And so I thought, let's start there. And by the way, for people who aren't aware, they call you Chartolini because you produce some of the best ETF charts out there. I would say, especially on ETF flows. And so that's where I want to begin with you, because I do feel like you cover ETF flows as closely as anyone in the industry. So, which ETF flow chart most has your attention right now? Like, what's standing out to you over these first 7 months of 2026?
Yeah, I would say the first one is just the path and pace of flows because we already broke 1 trillion in the first 6 months of 2026. And simple math says that you're going to break 2 trillion of just double what you did in the first half. But I think you can extrapolate that a little bit more, knowing that you typically do get a second half seasonal bump, particularly in Q4, as more tax motivated trades come through, some different window dressing and things along those lines. And so when we think about this, the most compelling chart is trying to forecast where we may land because it's going to be a rarefied air. And we think just based on the path and pace we are now, or even in the last 12 months, you're already over 2 trillion, which it would be a record and is a record for any 12-month period. We think that the full year 2026 number is probably going to net out around 2.3 trillion, which is just a massive number to consider. Given that it wasn't a couple of years ago, we had a hard time even breaking above 1 trillion. Now we can do that in 6 months. I think that just showcases the growth, maturity, and significant adoption within the broader ETF ecosystem.
Yeah, and it's amazing. I mean, you look right now, we're at nearly 1.2 trillion, as you know, and you were alluding to. Fourth quarter tends to be the most prolific for ETF flows, and so if you extrapolate that out, to your point, it's not surprising at all to think that we could hit 2.3 trillion, 2.4, 2.5 maybe, because you look over that trailing 1 year, and we have had over 2 trillion into ETFs. Let me ask you this: if I look at the top of the ETF leaderboard right now, if I look at the individual ETF flow leaders, the top three are all S&P 500 ETFs, which that obviously includes the State Street Spider Portfolio S&P 500 ETF, ticker SPYM. That has over 50 billion in inflows, actually number two overall. And I do want to ask you specifically about that ETF here in a little bit. But I also see a Nasdaq-100 ETF. There's a U.S. total stock market ETF. And then just outside the top 10, I see SPY, the State Street Spider S&P 500 ETF. My point, Matt, is a ton of money continues piling into large cap US stock ETFs. And I was talking a little bit about this in my prior segment. Does that concern you or surprise you, just given some of the investor worries around valuations? And you hear about index concentration and all those sorts of things. Does it surprise you that we are seeing flows into these types of ETFs, which is obviously helping drive that record pace that we're on in the industry overall?
Yeah, so I would say it concerns me, but it doesn't surprise me. And the answer to that actually has two different paths of an answer. The non-surprising fact is due to investors typically do exhibit some form of a home bias. And owning the US, for the last 15 years has been a particularly winning trade. So you still see investors are piling into broad-based US exposures, but also the unsurprising part is we see just more adoption of ETFs, more core-based adoptions. And what you referenced, S&P, NASDAQ, total market, those are all core elements in portfolio construction. So it's not surprising with greater adoption in the ETF ecosystem that the core benchmarks are receiving a greater than what you would say majority would be of fund flows. Now, what is concerning though is this level of home bias. So if you look at even in July, 73% of all flows into equity went into US equities. Now, that number is well below the levels of concentration we saw, say, in 2024 and 2025. That number has started to come down. So that is an improvement on the concerning level of concentration. And the problem with concentration is that it can swing both ways. So it has been a benefit to those investors. And so you have some form of confirmation bias that the decision that they made to have that home bias has been a winning one. Problem is the sort of the future looks very different than the recent past, and we know that from historical case studies. And this level of concentration swings both ways, and that you will inherit the boom bust profile of the largest market you're exposed to. And we think in any market, in any asset allocation portfolio, being diversified is a better way to express capital and invest than being concentrated. So it's concerning that you can still see these levels of concentration, because that concentration has actually led investors to miss out. The US is not the most or strongest performing market in the global equity market space. You have EM that is outperforming it. ex-US stocks and sort of the developed market are matched neck and neck. But when you look at it on a single country basis, roughly 63% of all single countries are outperforming the US. Last year was 73%. We haven't had back-to-back years of a majority of non-US countries outperforming the US since 2006. So the tide is starting to turn, and a lot of that has to do with the retransformation of our macro backdrop that is it's sort of exuded and infused a different type of capital formation across borders.
Yeah, I just think it's tough for investors because, to your point, there are other areas around the world that are absolutely outperforming the US. And even within the US market, as you know, you can look to areas like small caps, which are outperforming. The problem is the S&P 500 is still up, 9% year to date. And we know what it's done over the past several years. And so I do think some investors and advisors, they see those returns and things are pretty good overall. And maybe they haven't looked to some of the other areas of the market. And that's kind of reinforces that bias, if you will, because we're not in some sort of drawdown. I guess on that note, I was asking this, and again, the previous segment, do you think it will take a substantial drawdown to change the composition of the individual ETF leaderboard? Or do you think we'll always see these types of ETFs, these sort of core passive index-based ETFs at the top?
I think you'll, unless there's a tactical shift where you do have a drawdown, you would probably see more 1 to 3 year month Treasury bill ETFs like a BIL, maybe make its way into the top of the league table. But when you zoom out and you look at it maybe on a full year basis, if you're to look at every year and see who's at the top of the table, it's probably going to be filled with these core benchmarks, because ETFs represent the ability to express core views strategically at a transparent, fee efficient, tax efficient manner to well-known venerable benchmarks that everybody sees at night on the nightly news, don't have a cultural resonance, but also have an investment resonance over a long time period. And we do know that there are 3 secular drivers impacting impacting ETF flows. One is low cost, another is active, and underneath that is bond ETFs. Bond ETF usage has continued to increase, and those are core benchmarks too. So I definitely think you'll see core benchmarks sort of always up at the top of the table. Same way, Man City or Chelsea and Liverpool always sort of dominate the top of the Premier League.
I love how you always work in some sports analogies. You do that in your monthly writing. I thoroughly enjoy that. Real quick before we move on, because I do want to ask you about some specific State Street ETFs. If I look only at equity ETF flows, I'm showing about 750 billion has gone into equity ETFs this year, which that's a ridiculous pace, by the way, just mind boggling. And like we were just saying, obviously these big, low cost, plain vanilla US ETFs are leading the way. I'm just curious, is there anything else that jumps out to you when it comes specifically to equity ETF flows? Do you see any other notable big picture trends?
So I would say 3 things. So I'll try to be quick on this. So value is outperforming growth by about 18% this year, yet value and growth flows are neck and neck. I think that's interesting because it has been such a growth market over the last decade, and value's having its time in the sun, and we are seeing the same level of inflows. Big inflows, 64 billion year to date for E, but you're not seeing that disparity. Secondarily, we're seeing about 60 billion of inflows into sector-based ETFs, but it's very heliocentric towards tech, which is interesting because tech is not the best performing sector. Industrials are, energy is. And so money is going to, I would say, more market narratives than market leadership from a momentum and performance perspective. Tech's still in the top 4, so it's not like it's the bottom of the barrel. But you would see, some opportunities in that industrial space because of the cyclical upswing we're seeing from that AI CapEx build out. And so I think there's more that can be done within the sector space that investors may be missing out because of that concentration. I think the third one is there's a little bit of missing the signal through the noise, so to speak, when it comes to your market capitalization. I wrote a blog post still July, so in July, earlier part of July, about the sort of durable rally in small cap, and highlighted that small cap are outperforming large caps, like we haven't seen in over 20 years. What was interesting is when you break down it by sector, every single small cap GIC sector is outperforming the large cap GIC sector this year. That has never happened in over 30 plus years of index data. So something has fundamentally changed within that small cap market. And a lot of it has to do with the AI CapEx build out and sort of those dollars making its way to smaller companies. And now you've seen small caps have actually positive flows this year, about 9 billion, after having outflows last year. If I was going to smuggle in a fourth one, it'd be emerging markets. Emerging markets have 42 billion of inflows. The year ended today, there'll be the most flows for any calendar year ever for emerging markets, outpacing 2017 when it had 37 billion.
Yeah, I think the question on emerging markets is the performance we've seen there sustainable? I know this has been a recurring theme. You and I have talked about that before. I still think that there are a lot of investors and advisors who are skeptical of international just because they've been burned by it in the past. It's underperformed for long periods of time. So I still think we need to see. I don't necessarily need to, but I think there's a large contingent of investors that still want to see sustained outperformance there. But you look at what's happened, again, particularly in emerging markets, has been a great place to be. I also think your comment regarding tech sector ETFs is interesting because, again, you know the flows better than anybody. But you look at a chart of tech sector ETFs versus other sector ETFs, and the tech sector flows are just like straight up and everything else is roughly flat. And it's just amazing to see how everybody's piled into that singular place.
I was gonna say, I think I misspoke too. Tech had 60 billion. All the sectors have 87 billion. So I think that really paints a good picture. What you're saying, a lot of the flows are just into tech, and there's some opportunity elsewhere.
No, it's remarkable. And I was just going to say on small caps, again, with the outperformance there, I do think that that's going to continue to be a space that gets more looks. And I expect flows to continue accelerating into those products. Okay, let's get into some State Street ETFs. I mentioned at the top, there are a couple of, I think, very noteworthy stories here. And first, I think we have to come back to the State Street Spider Portfolio S&P 500 ETF, SPYM. This was recently selected by the Treasury Department as the exclusive default ETF for Trump accounts, which, Matt, to me, this looks like a huge win for State Street. Here we have an ETF that is now the default option for accounts where billions of dollars will be flowing every year. How excited were you to see this?
I mean, extremely excited because I think it just looks at what we have done over the last couple of years in terms of crafting different product strategies, building the fund to be a credible solution where it's not just 2 basis points and say $100 million. It was over $100 billion of assets. It had grown, it had been now being used by wealth managers, advisors, retail, large scale institutional investors. We've seen trading markets develop. And now you have the US Treasury Department coming and saying, like, this is going to be the default option for Americans to begin their investing horizon, time horizon, and career, thinking they can have it, this would be the first investment they likely to make at birth and carry that all the way through the rest of their lives. I think it was incredibly exciting. For me, I've been at State Street for a very long time and I've seen a lot of great things, but this is one of those things that's going to be a marker in time for me. Like, yep, I was part of that because it's also something I can share with my kids. Like, yeah, this is what you invested in because we set these up. And, the company I work for, when you see me go to work for every day, we're behind this. We're the fund that is going to invest in this. For me, extremely happy to see it. And I think it just speaks to how the legislation was written, low fee, broad-based, US benchmark, and all those attributes. That's basically SPY-M to a T.
Yeah, SPYM clocking in at only 2 basis points on the expense ratio. Do you think there could be like a halo effect here where you have all of these children that over the years they'll become familiar with State Street ETFs via SPY-M, and so maybe as they enter adulthood, they already have a level of comfortability with that? Or do you think that could be a real benefit, or is that maybe overstated?
No, I think it's a real benefit. I think it's just a benefit to State Street. It's a benefit to financial literacy. It's a benefit to just how you can invest, to the ETF marketplace. What are the options out there? And understanding the very nature of time in the market is better than timing the market and the ability to grow that capital. I mean, I think I look at, my generation, we were sort of the first to really have like cell phones that could work outside of, different buildings or in tunnels. And then we had interfaces, we had iPhones and connected to the internet. Now that's ubiquitous. If you give a 10-year-old a phone and you can't connect to the internet, they're going to think it's a paperweight. And I think I view it the ETF market the same way. They're going to grow up with us. They're going to understand. I'm not going to have to explain what the in-kind redemption creation process is and how that can impact your taxes over a long time frame. It's going to be just known. And I think that's extremely helpful.
Yeah, I love your point on financial literacy. I've talked about that a lot. I think it's a real problem in this country. And so anything that we can do to improve financial literacy, including via these Trump accounts, I think is an enormous win. But for SPYM, I mean, I mentioned earlier, already over 50 billion in inflows this year, and now has this tailwind behind it. So, certainly great to see for you. Another ETF I want to ask you about is a State Street Spider Portfolio Nasdaq-100 ETF, ticker QNDX. This launched a little over a month ago. It's now the lowest cost Nasdaq-100 ETF at 10 basis points. Talk about State Street getting involved in this category, which previously didn't have any real competition. So I feel like this is a really big deal as well.
It is. And it was great to see too. So back, I believe it was in April, I'm trying to get my calendar correct, that NASDAQ came out and was opening up the indexing agreement for the Heritage NASDAQ 100 index. And because of our large size, scale, and operational efficiency, but also our well-known space in the index business, we were offered the opportunity to have access to that license, and we were able to bring out QNDX at 10 basis points. And I think what's really interesting for me is when we look at our lineup, we have the S&P 500 with SPY and SPYM. We have the Dow Jones Industrial Average with DIA, and now we have the NASDAQ with QNDX. And I know that's the NASDAQ composite that's shown on the nightly news, not the NASDAQ 100, but those are ubiquitous too. And so we basically have those three well-known benchmarks that everybody sees. And I think for me, that's extremely helpful to sort of talk about financial literacy, to talk about investing, to talk about ETFs, and talk about the very well-rounded nature of our suite, offer broad-based core exposures to end investors at efficient prices based on the opportunity value that we can provide to end clients.
In terms of that efficient pricing, we already talked about how SPYM is at 2 basis points. QNDX is now the lowest cost Nasdaq 100 ETF. You mentioned DIA, the State Street Spider Dow Jones Industrial Average ETF. That's at 16 basis points, very competitive. Can you talk more about the overall fee strategy here? Which again, this is clearly working if we judge by SPYM's inflows and the Trump account selection. And I already looked at the interest around QNDX. Just talk a little bit more about that fee strategy.
Yeah, so part of it has to do with looking at our own operational infrastructure and where we can provide value to clients. And that's one of the bigger points. The other one is how does this fit within our broader suite? Because if you look at the name of QNDX, it has that portfolio moniker. And that portfolio moniker is for our low-cost core suite. So now we have 25 products across different parts of the equity and fixed income market that allow investors to build robust, diversified asset allocation portfolios. So we need to make sure that all those things line up and that it's not out of sync with our operating model and where we can provide value to clients, where it's not out of sync of the pricing within the portfolio ETFs. And that's how we look at it. We look at where we can provide value to clients, full stop. And I think we netted out at 10 basis points based on those factors at play.
With our remaining time, I do want to ask you about a couple of what I'll call alternative ETFs or multi-asset ETFs, again, because I was discussing these in the prior segment. Really just about how some investors are now looking to diversify away from the top-heavy indices right now. And some are looking to alt ETFs to accomplish that. And so State Street offers the Bridgewater All-Weather ETF, ticker ALLW. Looking this morning, that's seeing nearly $1 billion in inflows this year. There's also the State Street Multi-Asset Real Return ETF, ticker RLY. That has over 500 million in inflows. I'm just curious, how are you positioning these types of ETFs to clients? Like, what's the conversation around these? And clearly there's interest here if you look at flows, but are you getting more questions around these types of ETFs now?
Yeah, we definitely are. I think a lot of it has to come down to the macro backdrop. They're rising fragility in that. It's probably not a lot of the statement filled with massive hyperbole. It's pretty well known if you look at the headlines. I think it's thinking about this idea of resilience. How do you try to infuse resilience and balance into a portfolio? Because for quite a long time, inflation was dormant. Between 2010 and 2020, inflation averaged around 1.2%. Now inflation has become a more durable risk factor because of the macro backdrop really changing, the move from cooperation to more fragmentation, the move towards more combative trade policies. And that has had an impact on inflation and other macro factors. And so now investors are trying to think about how to infuse more resilience, balance, and diversification into portfolios. And when I look at ALLW, we think it is one of the ways where you can capture all three, because you're going to be more diversified across regions. It has more regional diversification across stocks and bonds. It has more asset diversification because the portfolios we see are very, very heavily stock concentrated, and they maybe have a handful of nominal bonds and some credit, and you really don't have that inflation-linked bonds. You don't have a lot of commodity and gold as structural, strategic pillars in a portfolio, and those have a very different reaction function to changes in the macro landscape. Nominal bonds don't like inflation very much. Inflation-linked bonds can help mitigate the impacts of inflation. Same thing with commodities and gold. So you get that asset class diversification in accordance with more economic diversification. Because that 60-40 portfolio is really built for Goldilocks, and that macro backdrop is anything unlike Goldilocks in that time frame. So it's really about resilience. And we think about it as this one sort of area where you can capture those three sort of pillars: diversification, resilience, and balance. And then moving down the space a little bit more, if you want to have a more specific inflation resilience tool, we think something like RLY can serve that, because different inflation sensitive assets will respond differently to different economic trends and market trends. Inflation-linked bonds, it could be down because real rates are up, but they are outperforming nominal bonds because of that inflation-linked component to it. That's a cruise inflation. Commodities could be doing quite well, and gold could be doing quite poorly. We're seeing that right now based on different macro impacts. We think RLY, and I maybe have used this in multiple places, but I think it's a great analogy. RLY is sort of that seafood tower of inflation resilience. You have all the different components to it. Maybe someone likes crab legs, maybe someone likes mussels or oysters, but you have all of it one and together. You have inflation-linked bonds, you have commodities, you have natural resource equities, and you have all of these combined to actually have a portfolio that can maybe and potentially mitigate the shocks of inflation. I think for me, post 2020, we are in a new macro backdrop. That's not a big statement, where inflation has become more of a durable risk factor. And what have we seen RLY do? We have seen RLY have positive calendar year performance every year since 2020, 2021, 2022, 2023, 4, 5, and so far in 2026. There's not a lot of strategies out in the entire ETF and mutual fund market that can say that. And so for me, that's how we're starting to position these portfolios and have those conversations of how can you have more resilience? How can you have more diversification in your portfolios today?
Yeah. And to your point on performance, again, I was looking this morning, RLY up over 15% year to date. Just to your point, do you find, is there more education needed around these products, or is it a more difficult conversation because these are a little more complex, obviously, compared to plain vanilla ETFs on the market? Or if you're just looking at, say, a 60-40 portfolio where it's just stocks and bonds, obviously most investors and advisors have a pretty good handle around that. Or is it more difficult, the educational aspect? Like, how do you handle that?
Yeah, I think with anything that deviates from, say, S&P 500, you do need some education. And I think for all W, it's really simplistic in the focus it's trying to capture. It's trying to capture the risk premium out on offer that all assets share while mitigating the shift between growth and inflation. The implementation of that view is where the sophistication comes from. So, but if you just zoom out, like, what are we trying to do here? We're trying to hold assets, or what Bridgewater is trying to do, using the royal way. Trying to hold assets that can help compound growth over a long time frame and hold them in a way that mitigates the shifts between growth and inflation, and that growth and inflation volatility, which only creates volatility and doesn't have a return expectation tied to that. How can you hold those assets in a diversified way over the long time frame? The same thing with ROI. How can you build a portfolio that can be resilient to inflationary environments by holding real assets that have a different reaction function to changes in inflation than, say, traditional stocks and traditional bonds? And you can do that by capturing areas of the market that are more sensitive to commodity prices, like natural resource equities or own inflation-linked bonds, which accrue that level of inflation. So it's really trying to break down the simplistic, basic tenets of what the strategy is trying to strive for, which can be really, really basic. It's the implementation that becomes more sophisticated, and that's where we have a lot of those more due diligence questions that need to come up.
Putting aside alternative ETFs, in just a few minutes left here, I'm curious, are there any other State Street ETFs that seem to be coming up more in conversations with clients as potential portfolio diversifiers? And it's funny, just thinking on our conversation today, we've covered a lot of ground. I mean, we've mentioned small caps in the US. We've mentioned emerging markets. We've talked about ETFs like All W and RLY. Are there any other ETFs that again, seem to be flashing to clients right now as portfolio diversifiers?
But not so much on diversifiers. I mean, there's always, we have conversations with gold that come up all the time in terms of like diversification. I think it's, diversifying your portfolio outcomes is something that started to come up because we've written a paper about the new era of income investing. We've talked about how income investing is really challenged. The S&P 500 yield 1.1%. That's below the rate of inflation, below the rate of cash. The ability to get income is really, really scarce, but there's a rise in demand. So you have a sort of an unequal equation there of rising demand for income due to demographics, but then also a scarcity of income because of the way the S&P 500 capital is being returned from the firms through buybacks and not dividends, how low income paying sectors are now at the highest, right? So tech has a yield of 0.4%. So we've had more conversations about utilizing our State Street Select Sector Premium Income ETFs, which are, they own like XLKI, owns XLK, and then there's a covered call program on top of that, much like all the derivative income funds. So basically take something that yields 0.4%, sell away a bit of the upside, and get, potentially a higher income level. So you can still be that tech investor, but now you have a little bit more income with it. And that's sort of the idea. And, that suite debuted last year, I think today, of all days. And it's quietly grown to over 100 million. And I think, as we get more and more of the word out, that education, I think that's something that's going to come up a bit more because income is a very, very desired outcome in portfolios today. And the ability to get it from traditional assets is extremely scarce.
Any specific thoughts on gold? I know a lot of listeners are interested in that asset class. Obviously, State Street offers GLDM and GLD. Performance this year has been subpar. I think gold's down about 6%, but had an excellent last couple of years or year and a half or so. Any quick thoughts on gold?
Yeah, I think looking at the bigger picture, looking at calendar year returns, because you're going to look at it from last year. Last year was a significant price performance or outperformance to cash as a sort of a relative benchmark. But I think looking at it today, what are we seeing? We're seeing some degrossing, so selling of positions that were built up last year when gold was skyrocketing. And also, real rates are moving higher, and real rates and gold have a negative relationship to each other. So that sort of opportunity cost has changed the math associated with the valuation of gold. And then you did have some fundamental selling from some central banks as part of the ongoing war in the Middle East that put some form of downward pressure on the yellow metal. But I think when we just take a big step back, the role of a diversification tool strategically still plays. And I think taking the long view on having a structural position in gold is something that can be a valuable addition to portfolios. I mean, All W has a structural position to gold, so not very recent. It's diversification properties to different economic environments. And there can be some, short-term pricing negativity due to change in macro factors. And I think that's what we're seeing right now.
Well, Matt, this has been a really nice little tour through the investment world. We covered a lot of ground. I always enjoy connecting. Thank you very much for joining me.
No, thanks for having me, Nate.
That was Matt Bartolini, Global Head of Research Strategists at State Street Investment Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute's Certified ETF Advisor program. You can learn more at cetf.org. Next week, I'll be joined by Rebecca Venter, Senior Fixed Income Client Portfolio Manager at Vanguard. So she'll be presenting the case for international bonds, which I haven't covered those in a while. And then I'll also be joined by JP Morgan's Chief ETF Strategist, John Mayer. We'll be diving into several big recent ETF trends. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.